All right, so this is day 14 of my journey to a $500,000 stock market portfolio. So if we look at the equity in my margin account, it's 1921, so it dropped, of course. The markets were up this morning, but then dropped hard afterwards. So total equity in all my accounts with Questrade is about 63,976. So just from yesterday, my total equity dropped about $2,000. Quite frustrating. All right, so what did I do today? So I bought AMD today, and I actually gave myself some downside protection. So I bought 100 shares of AMD at 30.06, but then I sold the 28.5 strike, collected $2.66. So this gives me a cost of 27.4, and my max selling price is 28.5. So the difference is my profit, which is about 4% in 30 days. So what I like most about this trade is that I'm giving myself downside protection. So even if AMD drops in the next few weeks, so if it drops from 30 to 28.5, I still make my profit that I'm expecting. So that's what I like about this trade here. Now, what if it goes to 35? Am I missing out? Of course, I could have made more, but the thing is, I don't know what's going to happen, and I don't want to be in the predicting game either. I'd rather make consistent profit, even if it's smaller gains, but as long as it's consistent every month. Because how often will AMD go from 30 to 35? It might move within a certain range, but the only way to make money if you buy it at the low range and sell it at the higher range. So instead of timing it, instead of waiting for the stock to drop so that you can buy it and then wait for the stock to go up so you can sell it to make a profit, with covered calls, you can make that profit immediately. So now with this downside protection, choosing a strike that's lower than my purchase price, I make my 4% profit in 30 days as long as AMD trades above 28.5. And even if it trades below 28.5 come September 27th, well, my cost is 27.4. So it really has to go below 27.4 for me to start being in trouble. So I bought AMD because the stock dropped, and not only did it, so in addition to the stock dropping, I went with a strike price that's in the money. I also bought some more American Airlines expiring September 27th. I picked a 24.5 strike. So this time, I bought a 24.73, collected $1.28 at a 24.5 strike. So I'm left with about $100 of profit in 30 days, which gives me about 4% in 30 days. Now I have some old American Airlines that I bought at 28 strike. It expires September 20th. Now for sure, if it expires while American Airlines is still trading at 24, then the premiums for the following month will be lower. In fact, let's go see what I can get if I were to sell premiums at a 28 strike. So let's say I go till October 18. So I want to see what the premiums will look like 30 days out from today. So let's go to September 27th at a 28 strike. Premiums are about 17 cents, so $17. So it's not even 1% per month. So it's not great, but that's what happens when the stock drops too far from your purchase price. We've got Bristol Myers here that hopefully I want to get rid of. It's getting closer to my strike of 50. So last month I collected $36, but I just want to get rid of it because it hasn't been generating high premiums. Box has earnings tomorrow. Hopefully the stock goes up after earnings. I think it should because it took a big drop since last earnings. Dell, I bought at 52.8. The stock is trading at 45.6, but I'm not too worried because as you can see, even with the stock at 45.6, premiums are still kind of decent, and I'm pretty sure it's going to come back up. So I'm not too worried with Dell. This is a good one. EWZ I bought on Monday. It's about at 38.67. It's trading right now at 39.03. But I gave myself some decent downside protection. I went all the way down to 37. So I don't care where the stock trades at. As long as it's above 37, I make my max profit of, I think it was $100, I believe. I don't remember, but I think it was $100. Yeah, about $108. That's my max profit in about 30 days. But return-wise, that represents 2.7%. Now, I've got Goodyear here that I sold a call option the first month, did well. Now the stock is all the way down to 11. Now I don't know what to do with it because my strike is 15. So I don't want to sell a call option below 15. But when I look at the 15 strike, it doesn't give me anything decent. And my goal is to generate income from my positions. Even if it's not the same income every month, but I want to generate some sort of income from my positions every month. That's my goal with covered calls. So if I look at Goodyear tires, and then let's say I go to September 27th, let's even go to October 18th. So 51 days out, 15 strike. There's nothing. No one wants to buy a call option. So I can't even sell it. I can't even sell a call option at a 15 strike. The only thing I could get is probably 10 cents, which is $10, and that's at a 13 strike. But then I risk selling my shares at 13 if Goodyear Tire ends up above 13 come October 18. And it's kind of risky because 51 days out, anything can happen. So I don't want to do that, but it looks like I might have to if I want to generate some sort of income from all my positions. I guess I made the mistake of buying an unknown stock. Well, not an unknown stock, but not the best stock. Let's say I go to January, which is quite far, 142 days out. See, at a 15 strike, I can collect $15. But that's $15 in 142 days. That's pretty bad. Plus, my position is in a margin account, so it's costing me interest just to hold the position. So I need to make more than about 7% per year for these trades to make sense. So what I'm thinking is, so the stock is trading at 11. Now I can go to September 20th, which is the next monthly cycle. And let's say, see, with Delta here, it gives you the probability, statistically speaking, that the stock trades above the strike price come expiry date. So according to this, there's probably a probability of around 10% that the stock trades above 12.50, but the premiums are low. If I go to 12, there's probably around 20% chance that Goodyear Tires trades above 12 come September 20th. I can collect about maybe $12. Minus commission, I'll be left with $6. I guess that could be a possibility. Stock is trading 11 and then 12. I mean, it would have to go up about 10% in 4 weeks or 3 weeks. So if I'm truly confident that Goodyear Tire will not go up 10% in 3 weeks, so will not be above $12 come September 20th, I guess I can sell a call option at a 12 strike, collect $10 or $12. See, the closer you are to the stock price, the better the premium. So if I go to 11.50, I can collect $25, which is good. I'd be happy with that actually. But then if the stock trades above 11.50, then I sell my shares at 11.50, but it cost me 14.8. So yes, I get the $25, but I lose money selling the shares almost $3 to $4 less. So that's not smart. Well, another thing I could do is probably buy 100 more shares of this and lower my average cost. So if I bought it at 15, let's say, and then I buy somewhere at 11, so my new average cost is 13, and then I could sell at a 13 strike. But even at September 20th, it doesn't give me anything. No one's buying. If I go to October 18 at a 13 strike, I can collect 12 cents. So 12 divided by 13 is not even 1%, and that's in like 7 weeks. So it's not great either. I'm leaning more towards taking the risk and selling a call option at a 11.5 strike. I'm just hoping that it does not reach or does not go above 11.50 come September 20th, because that's the only way these type of trades make sense. Otherwise, these trades don't make sense. Plus, there's no earnings coming out, so it should not move hard anytime soon. But earnings is not the only thing that makes a stock move hard. So many factors to consider. But I'm thinking even if the stock goes above 11.5, so according to this, there's a 30% chance that the stock goes above 11.5. So first of all, it's unlikely, but let's say it does go above 11.5. If I don't want to sell my shares at a loss, almost $3 difference, I could buy back the call option, so it'll be at a loss, but I can add it back to my future selling price. So that means whatever I buy the option back for, let's say the stock ends up at $12 come expiry date, so I'm gonna have to buy back the call option at 50 cents. So that 50 cents, I can add it to my future strike. So now my selling strike can no longer be 15 like I want it to be. It'll now have to be 15.5 because I have to take into consideration the 50 cents that I paid extra to buy back the call option, which has a 30% chance of happening. So the odds are still on my side, but there is a way out in case it does happen. Yeah, I think I've convinced myself. I think that's what I'm going to do tomorrow. Sell at 11.5 or even 12. What does 12 give me? 0.12 divided by 15 in 3 weeks. See, the problem with 12 is after commissions, I'm left with $6. So it's not worth it. Not worth the risk, at least. Got the same issue with Kraft Heinz. Look how far off I am. I need a strike of 36. I can't get anything at 36. The stock is trading at 25, so I need to get closer to 25. But the closer I am to 25, the further I am from my cost. So I have this other Netflix Iron Condor expiring September 6th. Looks like it's going to cost me money as well, almost $500. So the call side is going to be profitable because it's a strike of 325, and it doesn't look like it's getting close to that. But my put is at 320. So I need Netflix to be above 320 come September 6th, and I don't think that's happening. I mean, Netflix is trading at 291 right now. So from all the videos that I've watched on YouTube, one way to fix this Netflix trade is to close it out early and then just sell another Iron Condor. For example, if the stock's trading at 291, maybe sell at 270 put and then the call at about like 320. But then 30 days out from the day that I close this trade out. But that would, I tried placing this trade today, would get me about $150. So it's actually going to cost me $500 to close this trade, and then I get back $150, which is not confirmed yet because I only confirmed the 150 at the next expiry date. But the mistake with this trade is placing it at the beginning. This was a trade I placed before earnings, one day before earnings, just to take advantage of earnings because there's a lot of volatility before earnings, and as soon as earnings is announced, volatility drops. But sadly, the stock moved outside my range after earnings, and I tried to fix it. I tried recovering it, but I just kept rolling it over to the following month, and I just keep losing money on it. All right, let's not talk about it anymore. All right, so Nvidia. So this is a trade I placed last week. It's doing well. I mean, my max selling price is 155, so I don't care what happens. Anything above 155, I don't care what happens. As long as it comes September 20th, stock is above 155, I make my max profit of $400. So I like that I'm giving myself a lot of downside protection, but I still make a profit. So I've got SNC, Canadian stock. So I bought this at 21.75. It's at 16 now. So everything's dropping, but at least I'm collecting some premiums. Not the greatest, but still collecting some premiums from it. I've got this vertical call here. I've got this vertical call that it was part of an Iron Condor, but I didn't close it out because I knew it was going to expire worthless, so it wasn't worth closing it out because I just need the SPY to be below 310, and it's at 287 now, so it was for sure was going to expire worthless, so I didn't have to close it out. I've got this vertical put expiring September 20th. I need the SPY to be above 293. So right now I'm losing about $116 if I close it out early. But it's worth waiting because I think the SPY will be above 293 come September 20th, so I'll wait. And I've got this other vertical put. I need the SPY to be above 277 come September 13. This one is showing a very small profit, but it also has a good chance of being 100% profitable as long as the SPY remains above 277 as it is right now. It's at 287, so it's 10 points away from 277. But the closer I get to September 13, then I can make my max profit. So this was an $80 max profit. See, I could probably close it for 80 right now. So it's still too early to close. Now I've got this Iron Condor that I placed last week, I believe, expiring September 23rd. I think I collected $130 on this, and I can actually close it out for about 120 about. So it's only a $10 profit. So it's still too early to close, so I'll have to hold on to it. I make my max profit as long as the SPY stays above 275 and below 300, which I think has a good chance, given that the SPY right now is at 287. I've got this vertical put on Tesla, expiring September 20th. Max profit is $100. I think right now it's at a loss, yeah. So Right now, if I wanted to close it, I'd close it for a loss of about maybe $20. But Tesla's trading at 215. I just need Tesla to be above 200 come September 20th. So it's got a good chance. So I'll just hold on to it. So Uber was a covered call trade that went bad like many others. Bought it at 40. It's trading at 33 right now. But I was still able to collect $25 up until October 4th. We'll see what happens come October 4th. Hopefully Uber comes back up. Weight Watchers is another. So Weight Watchers is an example of what I'm afraid of by picking a strike that's lower than my cost. So I picked a 25 strike when Weight Watchers was trading at 19. So I initially bought the stock at 30, but I sold a strike at 28.5 to begin with. So my max selling price was always 28.5. So I'm okay selling the stock at 28.5 because I collected enough premiums for that to make sense. Then the stock dropped to 17 and 19. So the only strike I was able to sell a call option at was 25, and I did that a few times, and it was safe. The stock did not go over 25. I even sold one at 22.5, and the stock didn't go over 22.5. But then all of a sudden the stock goes up really hard, almost from 20 to 25, then from 25 to 30 in maybe in 2 weeks. So now the stock is trading at 29.44, and it's above my strike of 25. So that's the issue now. I don't want to sell. I don't want to lose my shares at 25 because my plan was to sell it at 28.5. If I sell it at 25, I don't lose money on the trade, but I also did not make any money while I was holding the stock. So it's basically, it was a waste of time holding the stock, plus the interest I had to pay holding the stock, plus opportunity cost. I could have used that capital towards something else to generate money. So in that sense, I would lose money if I sell the stock at 25. So I prefer not to sell the stock at 25. I'm hoping the stock drops back to 25, so I'm not forced to sell it at 25, and then I can sell call options again. But this time I'll pick a 28.5 strike or even a 30 strike. So United States Steel, this really doesn't make sense because this stock has the lowest PE ratio I've ever seen, but I have an average cost of 18.29 on the stock, and the stock is trading at 10.34. But I have the same problem now. I want to sell call options again, but at 18 I don't get anything, so I have to get close, probably even to 12. But then I have the risk of losing my shares at 12. Same thing, same risk that I have with all the other stocks. But it just doesn't make sense because if you look at this PE ratio, it's below 2. That is so low. The stock just keeps dropping, but according to its earnings, it should be trading for way more. That means the stock is really undervalued. So I don't know what exactly to do with this either, because I think it'll bounce back. This has a good chance of bouncing back, so I'm afraid to sell at a 12 strike and then it easily goes past 12. I'm thinking maybe of buying some more, but I mean, it's enough. I mean, I'm already down $3,000. I don't want to put more money into it. But right now, if I buy more United States Steel, even just 100 shares expiring, let's say September 27th. So at a 10.5 or even at a 10 strike, I can collect 9.45. So that's a very good return. So this stock still is able to generate decent covered call returns. But then if I do this trade, then I do nothing with the other 400 shares that I have. So the other 400 shares that I have is capital that isn't doing anything for me. It's just stocks that I have to hold on to and wait until the stock goes back up. But who knows when that will happen, if it happens, right? So I could probably sell another 100 shares. So buy 100 shares, sell a call option against it. If the stock stays below 10.5, then I end up keeping the shares and it lowers down my cost. But it still would not lower it enough for me to sell call options on the whole amount. So I think once again, the only way I can generate income from this stock is to sell at a 12 strike maybe. Let's see what that gives me. So yeah, even actually this is in 1 week. Let's go to September 20th. So 12.5 with 8 cents, I've got 400 shares. So 4 times 8 is 32. So I guess I could do that. I could do 12.5 for September 20th, and it's about a 15% chance that the stock trades above 12.5, statistically speaking. But obviously anything can happen. This doesn't take into consideration weird events. It's just statistically speaking, the stock has about a 15% chance to be above 12.5 come September 20th. So odds are on my side. So I could probably sell at a 12.5 strike, collect some income. I think that's what I'm going to end up doing. So Zillow is dropping a little bit, but I'm pretty sure it's just general market related, but I'm not too worried. I've got a strike of 34. So, but I think my cost is about 32 something, so I'm not too worried about it for now. TFC, I've got AMD, I've got Afria, which is terrible, really terrible. Not going to do pot stocks anymore. Bed Bath & Beyond also is terrible. Not going to do retail anymore. CHK. This is similar to United States Steel. I mean, it's got a very low PE ratio. Doesn't make sense why it keeps dropping. FCX is a bad one. Grubhub was a good one, but it took a big drop after... it dropped really hard when the general market dropped. Now it's at 56. My cost is 70. My initial strike was 70. But I'm still able to collect some sort of premium, but I'm confident that it's going to come back up. I think it's just related to general market. Halliburton, though, is hurting me. I think it's got earnings coming out soon, so I'm going to wait for earnings. Because I have a feel it should not be trading at this price, I think. If I'm afraid to sell it at 18 strike and then the stock jumps up to 22, I think it has a good chance of doing that. So I'm going to wait a bit on Halliburton because I think it will bounce back. Macy's is troublesome. My average cost is about 22 and I don't get anything at 22, so this is one where I'm gonna have to get closer and just hope that the stock doesn't go above my strike. Neo, I guess I could do the same, maybe at a 4 strike. Cost is 5, but maybe I could do sell at a 4 strike or even 350, but I think 4 would be safer. And Teva, really absolutely no comments on Teva. It's killing me, Teva. The sad part is if I had never bought Teva and I were to sell a covered call on Teva, it would be an excellent trade. I would make easily more than 5% in 1 month. I think even 9% in 1 month with a new Teva trade. But I don't want to add more shares to Teva. I already have 500 shares. If I buy another 100 shares and make, let's say, 10% on that trade, but then the stock keeps going down, then I've got 600 shares that are not doing anything for me. So maybe I'll just sell call option, I don't know, at 850 maybe, but it's going to be very risky because pharmaceuticals could go crazy. So Mabardi is not so bad. I've got a $2 strike. It's trading at 170, so it looks like I'm going to end up keeping the shares, but I'm collecting call options as I keep it. L Brands is terrible. I'm going to have to get closer to the current market price, although my strike is 26, but I don't think it's going to be coming up anytime soon. Novavax, let's not talk about it. Square, I'm happy with Square. I'm not worried about it. And Yeti. So Yeti and Square are pretty good ones. I'm happy with them. So actually, let's look how many good trades I have. So in my RSP, I've got maybe 1, 2, 3. 3 out of 5 are good trades. In my TFSA, I've got AMD, Mattel, and I would say Kroger is gonna be fine. I mean, my strike is 24. The stock is trading at 23. So yeah. So I've got 3 out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 3 out of 14 in my TFSA are good trades. The rest are just terrible. In my margin account, well, when I initially bought American Airlines at 31, I was really happy with that price, but I didn't know it was going to drop to 25 or even 24. All right, so let's say 1, 2, 3, 4, 5. So 5 out of 20 trades, I would say, are good trades in my margin account. Yeah, quite sad. Now, is that going to make me change my strategy? It could. I mean, at some point today, I was even thinking of just going into dividend stocks. But then, as I was looking into it, I saw some stocks that in 2014 and today are still trading at the same price. Actually, some of them are even lower today. So it's quite frustrating to hold a stock for like 5 years and then yes, you're getting dividends, maybe 4% per year, which is not amazing, but it's still easy money. It's passive income. But just seeing that after 4 years your capital hasn't moved is quite frustrating. But what I do like about dividend income is that it's completely stress-free. I am totally convinced that selling premiums is the way to go, but there are different strategies in selling premiums. So maybe I would consider a different strategy. But I am very comfortable with covered calls. And I just know that I need to be more selective in my stocks and not just pick any stock with high premiums. Try to pick quality stocks that don't move much but have decent premiums. And I want to master credit spreads because I know it can be useful. Credit spreads and iron condors. So like something like a Tesla trade, I mean $100 without owning Tesla, without having to buy 100 shares of Tesla. I'm making a bet. As long as Tesla stays above 200, I make $100. The capital required to make this trade is $400. So I'm basically making 25% in 30 days. But the only problem with credit spreads is after 30 days, I either make my money or I either lose it. So I either lose 400 or I make 100, unless I close the trade early. So I can close the trade early, but then I wouldn't be making $100. I'd be making maybe like $50 or $60. And then if the trade goes against me, I can also close it early. Instead of losing 400, I could lose $200. So that's the problem with credit spreads, is that you're always confirming either a win or a loss. But given that I have some stocks here that I'm just holding that aren't doing anything for me and are down a lot, credit spreads would make sense because every month you're just starting from scratch. And the idea is the overall portfolio should be profitable if you're placing the initial credit spread correctly, with the right ranges, with the right probabilities and the right pricing. But I think the key to credit spreads is management. What do you do when the trade is profitable, and what do you do when the trade goes against you? Alright, so this was my day 14 stock market portfolio. So if you have any questions, leave them in the comments section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.